Hi, everyone. Let's now have a look at this section where we talk about the frameworks, objective, and the underlying assumptions. While in the introductory section, we talked about these, the reason why, for example, we need a framework, and the underlying assumptions we talked about, of course, the accrual as well as the going concern assumption. We just want to go a little more detailed, right, around these aspects. So when I look at the conceptual framework, the broader idea is to have a clarification on what are those fundamental aspects. What is the foundation of building the financial statements? What are the foundation that we need to kind of have to prepare or present the financial statements, right? It also talks about the objective of general purpose financial statements. Bear it in mind that is specifically covered under Ind AS 1, which is presentation of financial statements, right? It also talks about the qualitative attributes, including, for example, relevance and faithful representations. We'll be discussing that as well. The underlying assumptions of financial statements, we have talked about it a couple of times already. It discusses the elements of financial statements. What I need to really be knowing as an accountant at any point in time, right? Especially when you qualify after becoming a chartered accountant, right? You would be required many a times to be asking yourself whether something is an asset or not, right? It appears very easy for us sometimes, right? But in reality, it can be really a question of argument, especially in the complex areas that we would be discussing, over the course of the over the course of time. When you look at the areas like financial instruments, you look at the business combinations, etc. It could be really typical to understand, what could be, for example, a liability or an asset or an equity, even talking about the basic elements of, let's say, incomes and expenses. How they should be read, how they should be understood, and when should they be recognized, right? So the recognition criteria is also discussed, and then the measurement part of it, along with the concept of the capital, something that we talked, of course, in the introductory framework. Of course, the purpose, of course, is to help the development of future Ind AS, and whatever are your existing Ind AS, right? They also need to be reviewed, right? Just imagine, a company is using an Ind AS, right? And it is facing some practical challenges in the application thereof, right? So how do you really ensure that the company is able to, for example, get the right understanding? As we said, it's a principle-based framework. It's a principle-based standards that we've got under Ind AS, right? So how do you really apply that? So the framework is the foundation to support that part, right? If there's a challenge that you're facing, you really go back to the framework, try to understand the different measurement criteria, or let's say the elements of the financial statements, and you come to, or you attempt to come to a conclusion, right? So in a way, the framework is a guideline for you. Okay. Similarly, the framework can also be used to establish the future Ind AS, right? So for example, in today's time, we can say that there's a standard on insurance which is due. So there is an expectation that it should be coming in a couple of years from now. So you start talking about, if I'm looking at a complex industry like insurance, then how should I look at each and every element within that sector? So the framework would support. So framework is the guiding force around it. Okay. And since there's a common framework around, it helps promotion of harmonization of regulations, accounting standards, and the procedures relating to the presentation, right? It's a clear guideline in terms of how you should be treating the elements, how should you be accounting for presenting those elements in the financial statements, right? It does not end there. Of course, even auditors would be required to look upon whether they are getting the right understanding of how the financial statements are, let's say, prepared by the client. Are they in lines with the Ind AS, and they develop their understanding, while formulating an opinion about the financial statements of their clients. So auditors look at the framework in detail, a lot of complex areas where the framework becomes a guideline, and that's something which is the expectation as well. And finally, it assists preparers and users to interpret those issues which are not covered by the standards. As we said time and again, Ind AS are principle-based accounting standards. They are not a volume of text that you keep on reading and try to get an answer on that. They are prone to subjectivity. So the basis of concluding whether something conforms with the requirement of India is you need to have some concept around it. The framework builds that idea. So you need to really go back to the framework at each point in time, right? We'll see why probably are we discussing that at length so many times, right? Uses of financial statements, you can name those, and that's what the list is all about. It could be a customer, it could be government, it could be providers of finance like a banking institution, or somebody who has, let's say, invested in companies' debentures, for example. It could be government, it could be employees, it could be shareholders, right? So there are multiple users of financial statements, and each such user has its own expectation, right? They look at their areas of interest, right? So somewhere the framework helps them read and interpret in the right context in terms of what these financial statements are trying to do or trying to say. Okay, now it would be unwise to think, it would not be logical to think that somebody who's not an accountant but let's say is willing to buy a share in a company, right? Maybe a doctor, maybe an engineer, right? Somebody who comes from a non-commerce background, for example. So are they also able to understand these financial statements, and is the framework helping them? The answer is a clear no, right? The framework does not expect to go in detail to teach you accounting, right? The framework does not go in detail to talk about why this disclosure is done, right? It is expected that those users have an understanding of, let's say, accounting already, right? You're not teaching them how to learn accounting. You're teaching them how to read financial statements, right? So you expect them to be knowing the basics of the business, the risks associated with the business, etc. already. Okay, so if you don't know that, the framework would not take a responsibility. But of course, the idea of the framework is to build that clarity in terms of how they should be, of course, interpreted, right? So when I say I'm looking at, the financial statement being prepared, the framework takes care of it, that all that information that you're sharing about the company's performance, the position, the cash flows, etc., right? And that's where you look at the balance sheet, you talk about statement of profit or loss, you talk about statement of cash flows. There is also a concept of statement of changes in equity. We'll see when we do Ind AS 1. So it also quote, there's the disclosures, of course. These are all the set of information, right, which is required, right? So it provides that information so that the users can take economic decisions, right? Users can understand and they can decide about their investment decisions. Should they continue to stay invested in the company? Should they rather even think of investing more, or should they simply exit, right? So the framework becomes a guiding force in that sense, right? So the users would be able to understand and take an economic decision about their investments, including understanding of how's the management operating, right? And also what is that which is lying in future. So that's something which is a precise but a very, very relevant objective of preparation of financial statements. Okay. Underlying assumptions, I don't want to spend a lot of time talking about it. Fundamentally, we look at accrual basis has to be followed, and the assumption of a going concern, right, is something which you would expect an entity to follow at any point in time, right? Accrual basis, we have practically understood accounting from the starting, only talking about accrual basis, right? So other than cash flows, we are simply saying that the financial statements, be it a balance sheet, be it a statement of profit or loss, statement which is in equity, and the disclosures around that, they should also be considered. They should all be considered using, of course, the accrual basis of accounting, right? That's something which is there. Going concern, we assume very clearly that the entity is expected to be a going concern entity. That is, the business would continue unless, for example, the business ceases to exist or the entity does not have an alternative but to liquidate. right? I think we would be able to assess this better. We would be able to relate this better to the COVID instance, for example, right? You may have come across instances, you may have read about that. There are few airlines businesses, they actually went under liquidation during the COVID time. Okay, in 2020, for example, it all happened. I mean, so what are we saying is that they did not really liquidate on the last date, wherein, of course, we are talking about the financial statements we prepared, right? They of course, got liquidated a bit later. But on the reporting date, on the last day, the management needs to make an assessment whether the entity would be able to continue or there is a significant issue with that assumption. Okay, and that is where the management and auditors need to assess that very, very candidly, that whether this going concern assumption is a valid assumption or not. Okay, so what are we saying is that if there is a valid assumption about going concern, then absolutely perfect. But you need to disclose in case there are significant uncertainties regarding the ability to continue. And in case, for example, the financial statements are not prepared on going concern, then you need to quantify, you need to assess in terms of what is the reason for not preparing these financial statements on a going concern basis, right? If I really take you back on the same example I was trying to refer to, that when you look at an airline sector, it is very much a cost heavy sector. It's a lot of borrowings of external borrowings are used to run the operations, and the margins are very thin. So when this COVID happened, practically the entire aviation sector got went into a halt, right? But there were still payments to be made for the aircraft that took on lease. There were still payments to be made for the interest that you took from on the loan that you took from the banks, for example. There was still operational cost to be incurred, but then there was no recovery of money because you were not selling anything, right? So if you are sitting on the reporting date when a balance sheet or the set of financial statements to be finalized, but you don't see any possibility of doing the business in future, even for a medium term. Of course, we are talking about something like a 6 months tenure, at least when COVID practically started. Obviously, it went beyond 6 months for many countries. So effectively, we are talking about, does the management strongly believe, right? Does the management strongly believe that they would be able to sail through that tough time? Okay. If not, then you need to disclose that part. Okay. And that is where sometimes we can actually argue, won't the management be simply saying that, no, we will continue? So even auditors need to question that judgment. And that's something which you need to look at, whether this assumption is appropriate or not. And it's a very, very, very significant assumption that we are talking about, right? So quickly, just to revisit this section, we are saying that there's a need for, of course, the conceptual framework. It talks about the objective, qualitative attributes, assumptions, elements of financial statements, and their measurement. This is something which is the summary of this entire section. The users could be multiple. The objectives are to talk about, of course, people should be able to take the economic decisions, the investment decisions. The user should be able to do that, right? So that is something which is more detailed talked about under Ind AS 1. That's the first standard that we'll be doing after discussion of the framework. And of course, the underlying assumptions of accrual as well as the going concern are important for us to consider. All right. The next section, now it seems a little conceptual, little theoretical, and well, it is a bit theoretical, of course, but then we talk about the qualitative characteristics. We won't be spending a lot of time talking about that, but this is one slide which you should be very, very comfortable knowing, right? We talk about understandability, relevance, which includes in itself materiality. We talk about reliability and the comparability, and within the reliability perspective, we talk about faithful presentation, substance over form, prudence, completeness, neutrality, and all these aspects involved, right? Now, when I say I'm preparing a set of financial statements, somebody is going to use that, somebody is going to look at it and take a decision about that company, whether they should be continuing with their investments or should they be pulling out their money back. So these financial statements need to follow some benchmarking, some kind of qualitative attribute, so that users are not, feeling like users are not being, made appear like they're made fool out of it, right? So it has to meet those norms well, right? There's no stricter, a watertight compartment that this is the way it should rigorously be, but it should be a bit more flexible. When you talk about understandability or relevance or reliability or even a comparability, you talk about something which is logical, which is sensible in terms of representation, right? So those attributes have to be followed by the entities, and the auditors need to ensure that these attributes are being addressed in the right context. So when I say I'm talking about understandability, we talked about that example where I say that if there's a doctor or an engineer who's going to look at the financial statements, unlikely he knows anything about accounting. So we are simply saying that the very basic thought process that the financial statements carry, that anybody who's going to be looking at these financial statements, they're assumed to have a reasonable knowledge of the business, right? They should be knowing what the business is all about, and accordingly, the financial statement should be precise without getting into too much of complexities, not a use of too much of a jargon or a detailed explanation of something, unless required under the Ind AS framework. Okay, let's take a small example around it. It says that simply, if you talk about an oil and gas company, which in itself is a complex business, right? Which is conducting, for example, exploration services, they would talk about it, what that industry is all about. So there are going to be some terminologies. There are going to be some terminologies which relate to that business. Okay. Me as an accountant who has never probably, for example, worked on or in oil and gas sector may not be able to appreciate that, right? So even if I'm an accountant, I don't get it, right? So when I'm preparing or when I'm looking at the financial statements of that business, I need to have a reasonable knowledge of the operations of the business, right? That's something which is the expectation that the users of the financial statement would know about the exploration activities, and there is no need to explain these basic terminologies which are used in that business candidly. But in case there are specific terms which are changing, then they should be specifically explained. And how is the presentation aspect? How is the measurement aspect? When I say measurement, I mean to say accounting for that. That should be explained in case there is a deviation from the normal scenario there. Okay. Relevance is again in lines with what we would know in the general meaning. We simply say that don't give anything which is irrelevant. It does not serve the purpose, right? That need to be relevant, and probably relevant and materiality. They need to be looked from the same horizon, right? So we simply say that something which would be relevant that can impact the economic decision of the users, right? So we are talking about materiality as a context of relevance only. Let's take a very small example around it. It says that a default by a customer who owes 1,000 rupees to a company with an asset worth of 1 crore rupees, of course, is irrelevant. You don't have to really go in detail. But maybe a default of, let's say, 20 lakh rupees really becomes a critical, relevant information. Okay. Similarly, if there is a, instance like a major fire taking place after the end of the reporting date, right? But before the issuance of the financial statements as a process, now this could be a relevant information again, right? You don't want to make the user wait until the next year or the next accounting period to explain or give the details of this so-called as a major fire there. So you need to be a bit more clearer about it. You need to be careful judging what is relevant and what is not relevant. So materiality, of course, is said that it goes in line. I think that's something which is being referred to, that information would be material if, for example, omitting that or misstating that or not allowing it to be shown, right? Obscuring that could reasonably be expected to influence the decision, right? So we are going a little more broader, where you say that even if there is a belief that it can influence, somebody's decision making, then you need to take care of that. You can't just ignore that information, for example, right? If I say, let's give a scenario, A has an inventory of 1 lakh rupees, for example, and then there are spare parts, finished goods, working clothes, and tools the materiality limit has been assessed at 30,000 rupees based on the management estimation. How should the presentation be done under the materiality criteria? Now, simply put, if I say my materiality limit is 30,000 rupees and there are different components within, for example, let's say, the inventory, it is desirable, it is appropriate to show any items separately which are meeting that materiality benchmark. And if I were to look at, let's say, the remaining part, if they are similar, then it's appropriate to club them too, right? So in this case, for example, I might be wiser to say my spare parts to the extent of 30. So let's bring that as a separate category. My work in progress, which is 40, and my finished goods and tools, for example, which is 25 plus 5, which is 30. It would be appropriate to use, the aggregation for these two items, because they together don't breach the, they individually don't really breach the materiality levels. Thresholds are within the materiality perspective. So that's how you start looking at, building that, right? So just to kind of highlight, this is something which is given in a more structured manner. We say that A has estimated the material limit of 30,000 rupees, which suggests that everything which is more than this amount, it is desirable, it is required for that matter to show it separately, so that users are aware of it. Anything above 30,000 rupees is clearly visible, it's separately known, right? Subject to the nature of, for example, the inventories. Therefore, the inventories would be on the face of the balance sheet, you would still show 1 lakh rupees, but as a part of disclosures in terms of the split of inventory, you can actually show the work in progress is 40,000 rupees, spare parts, for example, so raw material as 30,000 rupees, and the finished goods and tools combined at, let's say, 30,000 rupees here, right? Since the WIP and the spare parts are, separate items within the threshold limit, or along with the threshold limit, that's why they are being shown separately. But the finished goods and tools, of course, are combined together. Okay. Now, this one could be about the reliability. It simply means, if in case the information is relevant, but it's not reliable, of course, it does not again serve the purpose, which means that you have to give an information which is an objective information. You cannot give an information which is biased or has a subjectivity element, right? In a very simple scenario, I would want to put it like this. Let's say there's a company XY, right? It's a simple example that we have read about, and we can talk about it here. There's a company XY who is a director A, right? So the company advances 20 crore rupees to director A, which is okay. So there's nothing illegal about it. That could be allowed, right? But then this advance is shown as a part of an other advance. So let's say there could be a total advances given of 25 crores, for example, to employees, right? Of course, in the context of a director, even he's an employee. So this 25 crores to an employee as an example. So let's say 20 to the director and 5 crores to other set of employees. There's nothing wrong in this information, but this is not an objective information also. I mean, after all, director A is somebody who has the ability to influence the operation. So if he's taking 20 crore rupees, I'm not saying there's illegal to do that, but the shareholders would need to know about that. Out of this 25, 20 has been given to A, right? This is a biased information if this entire 25 is covered under, let's say, the advance to employees, because people would not get to know about it, right? It's a misleading information, and that's why it would require a separate disclosure, right? So let's take another example around it. It says that a legal case has been filed against A Limited. However, expected amount at the year end cannot be evaluated. What would be the relevant information and what would be reliable in that? Now, importantly, if the expected outcome cannot be evaluated, you still need to give a disclosure. You still need to tell what are the possible financial implications of that, right? That's something which you talk about the reliability perspective, right? It would not be appropriate at the same time to recognize the full amount of the claim, but at least a disclosure around that is going to be critical, right? We'll see these kind of instances, by the way. So this is something which is covered through related party, right? This is something which is covered through provisions, for example. So there are different standards which support. So the very basis of those standards is coming through these qualitative attributes as well. So you start connecting with that, the framework's requirement in this case, right? Faithful representation, again, I think the idea is to basically ensure that when you look at any of the elements, when you look at any asset or liability or income, etc., you're ensuring that there is a clear, faithful representation done of those, right? You cannot just make a recognition of something without merit, right? That's something which is the idea. Let's have a look at, for example, in this case, we say that any revenue which you want to recognize, but amount cannot be known, right? Then you are simply kind of projecting something which is not appropriate. It's unfaithful representation from the presentation and the measurement perspective, as an example for that matter, right? Similarly, if there is, for example, a recoverability of debtor which is remote, then showing that entire receivable in the books without provisioning is again not a faithful presentation, right? Very, very basic examples, very fundamental examples. But importantly, these aspects are well covered through different Ind AS also, right? If I say revenue, I'm probably referring to something like Ind AS 115. We'll study that in detail separately. The moment I say the provisioning part of it, it's covered through Ind AS 109, which is financial estimates, for example. Okay. Substance over form, very, very candidly, we hear this term so often, right? In the entire journey of accounting so far, we do talk about substance over form, and the classic example is leasing arrangement, right? So even if I say it's a lease, which means that I don't own the asset, in substance, I'm controlling the asset, and that's where you start talking about that whatever is the the substance or the economic reality, whatever is the basis or the reasoning of a transaction taking place, that should be used for accounting purposes, not the legal form. Okay. On paper, the contracts may say something, but you need to talk about the intent. You need to talk about the underlying reality of that concept there, right? So for example, if I say an asset has been sold from A Limited to Mr. X, and immediately after the transaction, X has leased out the same to A Limited, right? So in a way, A is showing a sale, and then A is also showing a lease back, right? Now, in essence, this asset never went out of A's balance sheet. And that's what we're trying to kind of highlight. So this is essentially a leasing or a sale and lease back concept. That is something which is covered through Ind AS 116. But where I'm trying to come to is that when you look at the word substance over form, we try to bring that intent. In reality, although let's say as a transaction, yes, the sale happened. There's no denial about that, right? And the lease back also happened. Again, that's not a problem. So in a way, there are two transactions. But the essence of this transaction, the essence of these transactions is suggesting that the asset was always there with A. Even though he sold it, it actually came back almost instantly back to A, rather than as an owner in form of a leasehold asset, right? So essentially, what accounting expects us to do is to look at the spirit of the transaction, and accordingly, you cannot be allowed to recognize a sale either, right? So practically, the sale would not be, shown in the books, and the asset would continue to remain in the books of A, and the transactions need to be accounted for accordingly. Okay, right? Neutrality is simply about making a clear information. There should not be any subjectivity. It should be a neutral information. For example, the whole idea is that the financial statements are not considered to be neutral either in the selection or the presentation of information if they, for example, can influence the decision making of the users, right? A very slight example around it says a company is facing litigation, although reasonable estimate of the amount of possible settlement could be made, the management decide to disclose its inability to measure the potential liability. Now, subjectivity comes. You cannot be allowed to just take it like that, right? It's important that you need to disclose it appropriately. Otherwise, the neutrality objective has gone. Practically, it's not getting met there. Okay. Prudence will see a lot of instances of prudence around it. Prudence simply says if you are seeing a loss which is unavoidable, okay, to simply book that loss, right? We have heard this term so many times, the conservatism principle of the prudence concept. It says that if there's a future loss which is unavoidable, right? If you're obliged to incur that loss, if there is a present obligation to incur that loss, please do make a provision. You cannot overstate your performance. You cannot overstate your position either. An asset, for example, if I say I have a car which I purchased for 10 lakh rupees, but it met an accident, for example, and I can only recover 2 lakh rupees out of that, you cannot show this car for 10 lakh rupees anymore. You will only be allowed to show for 2 lakh rupees. Importantly, prudence does not mean you can show whatever losses that you want. Again, it's a prohibited way to look at it, right? I mean, you can't just book any loss that you don't anticipate to incur, right? You need to be careful about that assessment also. Okay, a small example: receivables recoveries are basis on some estimates, etc., and prudent approach would need to be followed to be ensuring that your clear assessment of that provision is being done. You cannot just give a generic provision. You have to really measure it, keeping in view all the practical aspects there, right? Finally, on the completeness part of it, we simply say that the transactions should be completed, right? You cannot have anything which is left midway, right? It would be, for example, for any instances, if you're not putting every transaction which has taken place, you would know, and that's something that you study in the audit section as well, the cutoff dates, right? So those aspects have to be understood. If there is something which has to be recognized because the transaction has taken place just before the date of reporting, then you have to bring that into the accounting. You cannot just leave it midway, right? So those recognition principles, etc., have a role to play as well, right? Similarly, when you look at a brief example, let's say there could be some costs which are becoming a part of your operational expenses. So there could be something which is a direct cost above the gross profit, but you're booking it below the gross profit. That would simply overstate the gross margin. Then it should be ensured that it is appropriately at the right place and shown completely. It's covered completely in all regards from that perspective, right? Comparability, well, we'll deal with this part more in Index 1 specifically, but what it says is basically that if you are preparing the financial statements, then your financial statements for this year, right, should be comparable to your financial statements of the last year, as well as those of the competition. Okay, so in a way, you need to follow a structured format. You cannot just keep on playing around the presentation side of it. You cannot, for example, be allowed to use different accounting policies in different years, right? Because the comparability would be affected, right? The comparability is very much required because people would like to make an assessment of how it has been going, how's the trend, for example, right? And that's the reason why the comparability and the standardization of the presentation and the accounting policies has to be ensured by the entities there. Okay, very small example around it says that some expenses which were earlier shown under cost of sales, but now you want to show as other general expenses, is not an appropriate presentation. So you need to be carefully bringing that. Otherwise, your auditors can always qualify these statements if these are material, of course, right? So from that perspective, you need to understand that. even if these are not material. You're not allowed to do, an incorrect accounting. That's something that you want to take care of. Okay. Finally, when you look at, ensuring, let's say, bringing the relevant and reliable information, the bigger challenge that you would see that it has to be the financial statements to be prepared on a timely basis. So there is an inherent risk involved, right? While I'm using an audit language, but there's a risk involved that because the timeline is there, not everything would be covered, right? Similarly, it could be too costly to do everything to make it make it presentable in the relevant and reliable information. And of course, you have to really balance between all these attributes, right, of completeness, of reliability, of faithful presentation, of comparability, etc. You need to bring them all in the right perspective, right? A small section that we talked about, of course, you look at all these aspects of understandability, relevance, reliability, comparability. I think from an examination standpoint, if you can list those correctly, and you are able to explain them a bit if the examination asks you, that could be a good section. That could be a good learning out of this entire section there. All right. Thank you very much.